It's taking a while.
Oh, I think we are live now, Richard. Let's see. Got Cor from Holland. Good to see you. Good to see you. Giandrea, of course, always with us from Italy. Lovely to have you. Let me just get a few things set up here. Yeah, I think we have an interesting call today. I'm in an apartment here in Barcelona, so it's a little bit echoey in here. So it's I've done my best to adjust the sound. Hopefully it's not too bad. Def. Okay, Def is already starting the questions. We haven't even started. I love that eagerness. I love it. Okay. Okay. And actually, guys, today, this is going to be a really interesting chat because, we're coming to the end of the summer. I'm not going to talk for Richard, but he probably feels relatively the same that, something's going to break eventually. We've been around long enough where we've seen summertime blues where nothing happens in practically any, financial market. So crypto is not immune from that. And when things go, they'll go. And we want to be there when they do. So that's what this is about. As we wind down the summer, we want to be prepared for taking advantage of things, whether things move at the end of August, September, October, December, doesn't matter. We want to be there and benefit from it without costing us a lot of money to do it. So that's what we're going to be talking about today. And I have a poll here. Let me publish the poll. And I'll just read through it here. So basically, we have an idea of what our next courses we're going to put out. We want to do courses a little bit differently. Yes, it's good to have courses on the standard things that practically everybody talks about, sure, because it's part of a foundation of understanding. But we'd like to do a little bit things a little bit more specialized. So, a lot of people ask us about hedging. So that's the first option. If you'd like to see a kind of an in-depth hedging course using options and futures, both one or the other. And then there's two questions for sort of some broad trading strategies, directional. So we're taking, just talking about broad directional trades. If you have a bias or you want to be prepared for a move, talking about those, and then a non-directional strategies. And then on the opposite side of that, we're going to be talking about one. Would you rather just go deep into one strategy, like one of our favorite strategies, and we just kind of break down everything you'd ever want to know about that strategy versus having multiple for both directional and non-directional? So I hope that made sense. So please give us some feedback to help us build out that next course to help you guys as much as we can. What else we got here? Oh, and here, I'll publish this too. So, we always have this up, but we do have the 7 days free access for any of our packages if you visit our page, and if you join the silver level or above, then you get the interactive chat. You can talk with us, our live trade alerts, and then we also have a weekly Ask Me Anything call. We'll stay on there as long as you need, whether it's 2 hours, 3 hours, doesn't matter. That's what that is all about. It's a super, super helpful. It's a little bit more private. People can share a bit more without feeling bad or giving, not that we want your personal information, but it just allows people to open up a little bit more. So that's a great thing. We do have to reduce our time here at Deribit Live. As a result, we've gotten a little bit busier and we have to kind of throttle things back so we make sure we can take care of our members. So let's just see here. We've got some more chat coming on. Def, got everyone here. The poll is coming through. Good. So far, the hedging course, Richard, looks like it is the winner so far. So we'll just see how that goes to the end. All right, so let's get started here. What I'm going to do, I'm going to change the format up a little bit here. Let me just bring up the whatchamahui, the thingamajigger, the slides. And I'm going to put our faces a little bit bigger there, just because we're pretty to look at. Well, at least I am.
Speak for
and
yourself.
Get started. Yes, of course. So I'm just going to change it up a little bit today. I didn't change the slide. So normally we kind of take a look at our trades, what we got going on, what we think is going to happen in the market. There hasn't been a lot to talk about this summer, but that's what we do. And then I kind of get into a little educational component that's related usually to one of our trades. I'm going to flip it around today. And I'm actually going to talk about this education component first. And the reason why is I need to do that in order to understand the trades I have on when I show you my charts. So it kind of makes more sense this way. So what I'll do is I'll just go through, it's not a lot, some slides. We'll talk about diagonal spreads, a little bit about some calendar stuff in there and what I've got going on. Then we'll jump over, we'll share our screens and we'll show you what we have going on for positions and what we're doing. So without further ado, we'll get started. All right, so let's talk about diagonal spreads. These are probably one of my favorite strategies, depending on the circumstances, because it's so flexible and it's very similar to a calendar spread and even a standard debit spread. And in fact, and as you're going to see, and I'll talk a little bit later, we'll often start with one of those types of spreads, and then we'll transform it into one of the other ones. Now, diagonal spreads and standard spreads are generally more directional. You've got a directional bias, or you're preparing for that. And calendar spreads have a little bit stronger thonger. They've got some thongs. They've got a stronger theta decay element to them. So you're gonna get more theta decay with that calendar, and you'll see I've got both of them on shortly. Now, a diagonal combines that horizontal aspect, like the expiry aspect of a calendar spread, with the vertical aspect, talking about the strikes of a vertical spread. And you're basically buying two options with two different expiration dates and two different strike prices. That's it. You can be bullish, you can be bearish, you can do it with calls, you can do it with puts, doesn't matter. And now usually that long dated option is the further, or the long option is the longer dated, the further dated option, further out in time. And they're essentially a standard debit vertical spread, but that long option is just a little bit further out. So it's really quite a simple concept. Now, unlike a standard debit vertical spread, the profit can be more than the width of the strike. So when you put on a standard vertical spread, your profit is capped, right? That's all there is. And the reason is because the short option is going to expire prior to the long dated option. And at that point, you've got options as to what you can do. Now, they're directional in nature, like a standard debit spread, because we want them to move in the money. Ideally, we don't want it to happen too quickly, but that's the idea. They're very directional. So that long dated option is going to hold at least some amount of extrinsic value when that short dated option expires. And when this happens, there are options on how to deal with the rest of the trade at that point. Okay, so management options are going to, I realize our heads are in the way now. Let's make it a little lower there. Management options in terms of managing the trade are going to hinge around where the underlying market price is and where volatility levels are. So we can sell options against it like a covered call. We can do another diagonal. We can turn to a calendar spread where the strikes are the same, but the dates are different. We can do a standard debit spread. There's all kinds of things we can do. That's why it's such a great strategy, because it's super, super flexible. Now, if the underlying, so let's say we put on a call diagonal, let's say that underlying price moves away, so it kind of goes further out of the money, and the price of the Bitcoin starts to drop, and the position is showing a loss. I mean, the most you're going to lose is the amount you paid, but it's starting to look, you were wrong. That short option that you sold can be rolled down to recoup some of the debit and even lower your cost basis even more, or allow you to kind of hang out the trade a bit longer to give it more time to cook. Now, it's often used in a high IV conditions when you're using, when you're expecting a vol crush. So a lot of times people will use diagonals right before, like for stocks, for example, right before earnings, where they don't think the earnings is going to do much. Vol's kind of elevated. They're thinking, it's not going to happen. They take advantage of that vol crush, but they're still overall bullish or bearish on a particular asset, and they can take advantage of that with diagonals. So when you're setting up, just sort of a basic rule of thumb, try to keep the net debit you pay less than the width of the strikes, right? That'll control your loss. For example, if you've got a diagonal spread, you do it on an ETH or something, and there's $100 distance between the strikes you set up, well, the cost to enter the trade should be less than $100, okay? Ideally, kind of 75–80%. Simple. So why is this relevant now? Well, we're in the middle of the summer doldrums, right? We've got very low implied volatility. I personally don't expect the IV to increase very much for the remainder of August. We might creep up, but I don't expect anything major to happen unless there's some type of news event. So I expect to have the market, though, move in the coming months. And if we look at the history of Bitcoin and Ethereum, I think there's a good argument there to say that, yeah, we should expect some type of a move in the next few months at least. So I'm happy to sell sort of short-dated calls or puts to earn premium to pay for or at least reduce the cost of that long position, okay? And this allows us to be positioned long gamma and ready for a move and possibly to have that long gamma for free. So if the market doesn't move within the long dated options time frame, this will make more sense when I show you my chart, and you'll see I have an October trade set up. We're going to continue to sell a weekly option against it. So we're going to be constantly earning premium. We're going to continually drop our cost basis for that long option. Eventually, if nothing happens, that option is going to be free. It'll just be free. So we'll have free long gamma. It'll be beautiful, right? Let's just say nothing happens and we're in the middle or end of October and literally the market has not moved yet. Well, we'll just set up another diagonal because we know it's going to make a move eventually. We'll want to be there to cash in on it when it does. So let's just pop over to or share my screen, okay? And we'll go through my trades and then we can you see this, Richard? Can you see my screen?
Yep.
Okay, cool. And then Richard will jump on and talk about some of his trades. Now, I'm not trading Bitcoin right now. I'll be doing some trades in Bitcoin in the next week or two, but I wanted to just bring up the chart. Again, the unicorns are getting bored. And look, I mean, we had a bit of a move down, but it clung to that bottom technical line, and we're still doing absolutely nothing. Now, ETH is a bit more interesting here because I obviously got trades going on. The only thing I've done, so right now I had the short drunken condor I put on, if you remember last week, and these are my short strikes, 2000 and 1750. Well, both of them are right around 50% ROI. So I've literally, just before this call, I put in some bids to close that short iron condor out at a nice 50% profit. Now, what I did do is I put on two trades earlier this week or on the weekend or something like that. I don't remember. And one is a calendar ratio and one is a diagonal. Okay, so if it's going up, I'm going to be using calls, right? So what did I do? I did a 2x1. So I bought the 27th of October, 1900 calls. It wasn't at the money, but it was near the money. And I sold, sorry, I have to change this. This should be 1x2. Yeah, let me just change that so it looks a bit more normal. So nobody says, Shane, what the heck's going on with this thing? But basically, in this case, I bought the 1900 calls and I sold 2 to 1 of the 18th of August. So that expires next week, 8 days of the 1900 calls. Okay. At that point, let's just say the market doesn't do anything. The market closes right where we're at. I might have to manage this trade. I mean, we're only $50 away from that strike. Well, at that point, I'm going to roll that trade if I have to manage it. But if the market doesn't move, and let's just say for argument's sake, I didn't close that trade. It went right to expiry. I'm going to sell the next weekly against it, and then the next weekly against it. Now, I did the 1x2 in this case because I don't expect IV or the price to do a heck of a lot. So I'm taking a bit of a chance, sticking my neck out a little bit, but I'm doubling down, at least in this first week, and recouping the cost of this long call a lot faster. Now, normally I would just do 1x1. Now, if I'm selling the weekly against the October monthly, by about mid-September, this will be free. I'll have completely covered the cost of my October long call and I'll be positioned ready to go. I can't remember how many I bought in total, but I'm doing it 1x2. Okay, so this is a calendar because we're using the same strike in this case, the 1900s, but different dates. Now the diagonal is down the bottom. It's a diagonal because I'm using different strikes and different dates. So in this case, I bought the 1800 puts back there. We were, was close to the money, and I sold the 18th August 1700 puts to help pay for it. Again, every month or every week, I'm just going to sell the weekly, sell the weekly, sell the weekly around, mid-September-ish. Given that conditions don't change too much, those will have paid for themselves. And what will end up, let's just say that, we're over here in time and we're over here and these things are paid for. Well, let's see, October 27th, when it expires, is way out here, right? So I've got free long gamma at that point. If this market makes a move, and it's not, you can hear my trades going off right now. So I just covered these short positions on this drunken iron condor. But basically what I'm saying is, hey, do I think the market's going to be different by the end of October? You're damn right I do. It might not be, but I'm going to be there. I'm going to be long calls. I'm going to be long puts close to the money right now for free. That's why I love this trade. All right. So let's turn this off and I'll go back to Richard. We've got 10 minutes or so.
Yeah, I'll try and be quick. Actually, I can't. I'm liking your thinking on these 2x1 calendars. I might start doing that actually, because I agree entirely with your logic. So what have I got? Well, so yesterday we had a bit of a thing where I think there was a leak of the CPI numbers in the US, or a rumor of a leak, caused a little bit of vol to spike in the options markets in crypto. That was very welcome. And I was beginning to wonder whether this was like the end of the summer doldrums, but actually no, vols are all being crushed today. So I took the opportunity yesterday to sell a bunch of calls. I sold a bunch of $10 and $20 calls wherever I could. This morning I woke up, I do my marks just after expiry at ATM GMT, and then get my new trades on. And by this morning, vols were already coming off, and I was having difficulty getting filled. So I waited in there. So I've got a bunch of August calls coming off tomorrow. You'll see I'm actually at the money, or just in the money here on these short calls. Until 20 minutes ago, that was actually long calls, and I closed them. That was a 1x3 that I did a couple of weeks ago, which worked out really well. It made some good money. And I went to close these long calls and actually oversold them, so ended up negative 0.2. And I'm thinking I'll leave that for 6 hours to see if I can get it back cheaper. I sold it for 65 or 70, I think, basis points. If I can buy it back for 50, I'll be happy. Then all this comes off tomorrow, and that means my margin bill gets crushed tomorrow, which is great. And then I've been reverting back to my selling the 3-day call. I was just selling a 3-day $10 or $20 call every day. So yesterday I was able to do that at quite good vol. This morning, not such good vol, but we still got something. 30 vol's a bit pathetic, but it is what it is. And then I got a little bit on the 18th because I wasn't able to get much risk on. I just wasn't feeling comfortable about vols. I've got a load expiring on the 25th. That's where the bulk of my risk is right now. And I took the advantage yesterday to sell some longer dated calls in September and October. And actually looking at my vol surface, there's still quite good vol. If you're happy to sell the upside 6 or 9 months out, then there's plenty of people willing to buy it from you because they all think that crypto's going up. Actually, you can see here in October, we did put on some diagonals, didn't we, last week? These are my long legs of my diagonals, and I'm supposedly selling the weeklies against them, but I've forgotten all about that. I just keep selling until the margin runs out. I do keep selling, but I didn't realize I was selling against those because I'd forgotten I had them. Yeah. In terms of market structure, at the money vols are all really low, and then you've got a little bit of skew and curvature in the 6 to 9 month region and beyond. If you're happy to sell a 1 year call, I think you'll get quite a good premium for it. There we go. You can sell a 15 delta call at 65,000 for next March. I think that's a good bet. I think there's no way God's earth Bitcoin's going to be at 65,000 myself, but What do I know? That would be 100% increase, by the way, if that was the case. I mean, I'm happy to pick up that premium all day long, because you'd make so much money on hedging it as well, because the smile's so steep. Yeah, and then in terms of realized, vol index, there's yesterday's little spike, short-lived as they always are these days. So if you are going to be selling vol, get in there fast and sell it before everybody else does. And in terms of the historical vol, it's dead. So yesterday's spike doesn't even appear in the historic vols at all. And ETH is even worse. So you're looking at 21 realized vol. So if you're selling at 30 vol on ETH, I guess you're doing well. You're selling 9 vols above the market. So that's where
6
we are.
months ago we couldn't have imagined this, but here we are.
Yeah, so I mean now I get excited if I'm able to sell anything at 45 vol or higher. I get excited. Whereas 2 months ago I'd have been depressed selling that kind of vol.
That's exactly right. And then we see too the volatility surface has gone firmly back to normal, back to the call side across practically all strikes. And expiries. So
just a bit of skew up there in the far dated calls, and
it's kind of looking pretty normal.
I think I'm okay. I'd be okay with selling those 10 deltas all the way out there, even though the decay would be nothing. But actually, if you then delta hedge every day, what that meant would be if we do get a rally, your implied vol, your positions are gonna walk down that surface and give you profit. So it might be worth just selling a couple of speculative things out there and just delta hedging them, or even sell some risk reversals and delta hedge it with futures. I think that's probably a reasonable trade, right?
I'm going to leave that one to you.
Yeah,
I'm going to stick with some positional trades. Lovely. Hey, we got 5 minutes for some questions here. Let's just check it out here. Def, I was looking through your courses and I'm a bit confused regarding the time frame. In the courses you say to close your short positions before expiry due to increasing gamma. But on one of your webinars, you said that higher delta. I don't quite understand.
The question continues in the next one, and one week out strikes produce better results. So it depends on whether you are continuously hedging like I do, or whether you are planning not to hedge unless you have to. What happens? I mean, because I'm hedging often, I'm less affected by the gamma. But Shane, who's checking his book maybe twice a day, he's a bit more sensitive to high gamma, so he wants to be able to sleep at night without having to, wake up and hedge his book. Whereas I've got an algorithm hedging my book for me, so I'm quite happy to sell very short dated options.
Yep. And generally speaking, for most traders, you got to be careful when you're short of that gamma ramping up as you get closer to expiry, because of course gamma increases as you near expiry. A question from Ivar: how to manage condors along the way? Well, personally, I just treat them as two separate spreads, and if one side gets tested, I'll close it, roll it, whatever. I'll manage it whatever way I deem appropriate at that time. The side that's untested, I'll either let it expire or go buy it back dirt cheap. It's 5 delta, whatever. I'll just take it off, or I'll roll it up. So let's say I had it or down, depending on which side. So if I had an iron condor, the price is going up aggressively. I'm having to manage the call side. I might roll the puts up to get some more premium. Okay. I think it just depends on the market and what it's doing. Is it broken out of a range? Is it flailing around wildly? If it's flailing around wildly, I'm less prone to manage the untested side, because tomorrow it could be back down there again. So, but it's just a judgment call. At the end of the day, simple answer: I manage each side independently. I don't know if Richard, you have anything to add to that?
Yeah, if I think the market's going to range, I'll just buy back the good side and leave the bad side until it becomes good again, and then look to resell the bad side or the good side when I can do so to net off deltas. That's all.
Okay, cool. Let's see. We've got a question from Luke. As you ride the smile and dynamically hedge, do you always hold the position to expiry?
Not always, but in theory, yes. My reasons for buying back positions would be to manage margin. If I think I can get a better theta versus gamma equation somewhere else on the curve, I'll buy back somewhere. So generally for me, if a position gets to at the money and a short position gets at the money, I'll buy it back, and that's because I'm riding the smile, and then at the money is at the lowest point on the smile. So I'd rather buy back, one Bitcoin of at the money, one month, and sell, I don't know, 8 Bitcoins of 10 delta, to just to pick up the smile.
Mm-hmm. Mm-hmm. So just to be clear, Richard, you don't own a farm. There just happens to be a rooster outside the window.
Oh yeah,
It's not your
There's
rooster.
a nice little allotment there, vegetables and chickens and stuff.
Yeah, that's nice. Yeah, farm trading. All right. So another question from Luke. We've got 2 minutes left here. How do you manage if the price goes against you? I'm not sure. Like if we're talking about the diagonal or a condor.
I think it's a continuation. So the prices are always going to go against you. So your 1 delta hedge, hopefully, is enough and frequent enough to compensate. And if you get a gap in the market, and so the market gaps up or down, and so you're gonna have some realized loss, but you're hoping that you sold vol at a high enough level that over time it'll compensate. So yesterday I dropped about 1.5 Vegas of P&L, about 1% of my portfolio dropped in value, but the theta was high enough, that it all came back. Well, half of it came back last night, and the other half will come back tonight, and tomorrow it'll all be flat, and I'll make money into the weekend. So you just make sure just don't sell vol too cheap. That's all.
Yeah, and I think you had a good point there at the beginning of what you said. You said it's always going to move against you. We had someone new in our trading chat group who put on a position, it was the ratio, and then we had the big move up. It didn't go against them, but it threatened a little bit.
Should I just speed up some of these because we're running out of time? So, Luke, do you have a strategy about devol, buying straddle, selling devol? Funny enough, I've been talking about that with a friend of mine yesterday. I don't like it. I would rather just buy and sell the options, but you could do if you've got a strong view on vol. Do you dynamically hedge on certain times? I hedge hourly, every hour. I find that that's a reasonable compromise between a good hedge frequency and not spending too much money. Hedging daily also works. You just make a little bit less money. How do you deal with the boredom from Gene? You have a life. You go and do other stuff rather than trading. Enjoy the sunshine. Go walk in the hills like I do. Get married. Have children. In the end, there's no point making money if you're not going to live a life, right? Is it correct that when vol is high, you better hedge with futures, and when vol is low, with options? That's a reasonable argument. You could buy gamma when vol is low and sell it when vol is high, if that's what you mean. I guess you could buy. Yeah, if the skew is negative, you could buy calls. Skew is positive, you could buy puts and get a reasonably good value hedge. Yeah, why not? What vol catalyst are you expecting in August? None in August, but people will come back off holiday in September, and they'll be itching to do something. So clearly, markets are going to move. Do you use devol for hedging too? I know it's a product. Yeah, I've never used the VIX. I've never used devol. It's just too much complication for me. I'd rather just own the options. But you can do. And then finally, when you consider entering a position, what's your principal driver? Delta or vol? I'm looking for theta divided by gamma, and I'm looking for the highest, mathematically highest number I can get. I'm looking for the best decay for the least gamma risk. That's my personal equation.
Cool. All right, we've hit our time limit here. Again, thanks everyone for joining us and for partaking in our trades and giving your feedback and your questions. Now remember, you can always sign up for 7 days. We do a Monday call for members where we answer everything and anything on any topic. So if you haven't, please feel free to take advantage of that. You will see the link in the offer. Other than that, we will see you next week.